Coupang, the high-flying Korean e-commerce business, just IPO'd on the New York Stock Exchange. In this video, we're going to be analysing the business and its total addressable market, as well as discuss the current valuation and do a very quick and rough valuation, giving us a likely return based off the future growth of the company and its price today. Coupang went public at an initial valuation of $60 billion, and this equaled a share price offering of around $32 to $34. Since the listing, the stock price has climbed, as you would imagine, and now we have a valuation of around $89 billion to cough up if we want to buy the stock today. Coupang is run by founder Bom Kim, who is a Harvard dropout turned multi-billionaire since his stake in Coupang soared to around $8.6 billion just after the listing, meaning he owns about 10% of the company, which is very good to see as we have a clear owner-operator at the helm who has a very long-term vision for the company. I love what his vision is for the company. He really follows that Jeff Bezos Amazon framework where he wants customers to think back and go, how did we ever live without Coupang? Other notable owners of Coupang are SoftBank with the largest stake. They have 39% of the company, as well as companies like BlackRock, Sequoia, and Bill Ackman. As some background on the business, well, Coupang was founded in 2010 by Bom Kim, as we said. They're headquartered in Seoul, South Korea. You could say the company aspires to be Amazon of South Korea, establishing an end-to-end e-commerce logistics network that provides free next-day delivery 365 days a year, just like Amazon does. But they also have a grocery delivery service that's called Rocket Fresh. They have Coupang Eats, which is a fast food delivery service, and a digital streaming service that's called Coupang Play, and then lastly, a financial services product called Coupang Pay. This demonstrates their importance in a lot of customers' lives and really shows some drastic similarities to some successful US companies' business models. The company is best known for its customer-obsessed business model, which has driven its success so far. They have invested billions in creating and establishing its vast integrated logistics network. As of 2020, they have 100 logistics centers spread across various cities in South Korea. That means 70% of Korean population lives within 7 miles of a Coupang logistics center. And this is one of the distinct competitive advantages that they have. And it allows for 99% of Coupang's deliveries to be next day or faster. I don't even think Amazon has that sort of stat in its e-commerce unit, so that's very positive. Another impressive operation that they have that is very customer focused is their returning products method. All customers need to do is leave the product at their front door or wait for Coupang to come and pick it up, and the refund is processed as soon as the product is scanned, verified, and the driver leaves your door. Quite remarkable service if you ask me. South Korea e-commerce reached $90 billion in 2020, meaning Coupang should already have 10% market share. Now, I've seen various estimates for how quickly the South Korea e-com market will grow. Some are estimating it will reach $200 billion by 2024. Another one estimates around $100 billion. And then this one from Global Data, which seems legit, sort of meeting in the middle with an expected CAGR of 12%, getting the total market to $140 billion in 2024. The current user penetration is already quite high though, with 74.5% already integrated into e-commerce, and it's expected to reach 83% by 2025. So this does mean that at some point in the near future, e-commerce will flatline its growth to a degree unless they can start monetizing people a lot more efficiently, and maybe sooner than a lot of people expect. So they're actually the 6th largest e-commerce country in the world, ahead of, say, France and Germany. Now, Coupang isn't only in e-commerce, as we've covered. However, it does make up 92% of revenue, so it's the bulk and should lead in terms of revenue growth in the next 5 years. On the topic of revenue, you can see here they've experienced hypergrowth in the past 2 to 3 years with 3x in revenue in just 2 years, which is amazing growth. They've gone from $1.6 billion in sales to almost $12 billion from just 2016 to 2020. That's very impressive growth, like I say, and does deserve a rich valuation given they can sustain somewhere near to that level of growth in the future. One concern I do have is the cost of all this and the cost of having a customer-obsessed business model like they do. Now, we've seen this model work out very well over time with the likes of Amazon, Alibaba, Costco, and Apple. Making yourself that important and ingrained in customers' lives is so beneficial to your customer retention and long-term growth. We have seen that play out in many businesses before, but it does come with a cost. As you can see, their cost of revenue was 9.9 billion, which means their gross margins are at least positive, but only around 17%. And it's obvious this is because they run a first-party e-com platform where they facilitate all of the logistics. They have their own drivers and delivery services. So they aren't similar to an Alibaba, I guess, in the sense that they're not just an e-commerce facilitating platform. They're not a third-party e-com platform. So there is going to be higher costs there. Although we don't see, that lower margin profile with the likes of Amazon. They do have some operating efficiencies, with operating expenses only making up 20% of the revenue, so that's quite good to see. And, for now, they haven't actually shown real signs of reducing costs, over time with revenue scaling. I mean, this is now a $12 billion business in terms of revenue, so they're not small anymore. And, overall, the company is making a pretty big loss of around $500 million per year. I'm not saying they need to be profitable now, far from it. We've seen, this similar strategy with Amazon paid off massively. They sacrificed near-term margins and profitability for long-term growth, and that worked out very well for them. However, when you looked at Amazon, the path to profit was actually quite visible. For me, all I had to do was take out their huge R&D spend, some investment capex, and you could visibly see, at least a route to a 10-15% profit margin business. Here, I'm not sure I see that at the moment, just because the cost of sales is so high, and I'm just accounting for all of the costs that are going to be involved in this customer-obsessed business model that they have. And it's so hard because it's a really good thing, but it obviously does come with a lot of costs and isn't as feasible as you would like to imagine. But then again, I haven't dived deep enough into the company yet, so don't take my word as facts. This is just me talking about business economics. A quick glance at the balance sheet tells us they have some cash, 1.2 billion to be exact, although doesn't look like enough to fund the long-term growth and deficit that is likely to build up over the next few years. They did manage to raise over 3 billion in proceeds at IPO, so they will have a lot of cash on hand to fund that growth that you'd hope. Before that, they actually had more liabilities than assets, which is a concern, obviously, on the face of it. But a company growing at 100% per year will not have much trouble raising money should they need it, although it will mean dilution, so we have to think about that. Next, I want to see where this growth is coming from. So, are they accumulating a lot of customers, or are they just monetizing those customers more effectively through the network of products that they have? We can see that active customers is growing, which is positive. This growth year over year is around 25% on the active customer side, but the real driver is that revenue per customer number, which has increased from $161 per customer to $256 per customer, and that's a big leap, especially in a year's period. Now, this could have been, helped from COVID-19, which that's not to say that's going to stop. They'll probably help into the future, with everyone becoming much more comfortable with e-commerce and that becoming the main source of people buying and selling things on a day-to-day basis. Now, firstly, these numbers are fantastic, but what it suggests to us is they are somewhere in the middle of their growth curve, in the sense that new customer acquisition is growing, albeit slowing down over time. Like I said, this isn't a very small business anymore. And South Korea, the market, it's not like they've got 1% market share. They're already at around 10% market share. So that customer acquisition's slowing down slightly. But they are managing to scale the amount of money that customers spend with Coupang. So this is great in the sense that it should allow the business to become more efficient and profitable, because acquiring the customer is the most costly part of the sale. Receiving money from existing customers is less costly, even with Coupang's high cost business model. The negative here is that it hints growth may slow faster than expected, because at some point the revenue per customer will reach a threshold that's hard for it, or almost impossible for it, to exceed, given the products that they offer. After all, they are in the business of providing low cost integrated solutions to customers, not luxury items that have very low price elasticity of demand. And don't take my word for it though, this is one of the most impressive customer business models I think I've ever seen. I've got to say that. So they could prove all that I know about business economics to be wrong, if I'm being honest with you. And jumping over to the current valuation, we can see that they are selling at 7 times sales. And you might think on the face of it, it's not a bad multiple, it's not crazy. But remember, the gross margins we spoke about earlier, a business that has low gross margin potential will never sell at a high revenue multiple for that reason. And to give you an example or demonstrate this, even if we applied a theoretical 15% margin to their financials today, which would be being very, very optimistic considering they're not even 17% gross margins at the moment. So we say 15% bottom line. This still means that they are selling at 44 times EBIT or operating income today, which is a premium price, definitely, for a stock. But they are growing at an above average rate, near sort of 100% at the moment. Whether that will carry on, we don't know. But that's going to be the main reason why it's priced at such a premium. And now if we jump into a quick valuation that I've done, and this is more just to screen the stock and just see, you know, how much potential does this have on the face of it. If it looks really good, then we can explore going into the stock a little bit more. And so here's what I've gone with on the forecast. I've gone with revenue growth of 40%, but it's not exactly like I've just taken a 40% growth estimate. What I've done is I've tried to get near enough to 50% market share as a bullish thesis as to, you know, they will start to dominate the e-commerce market. They do have some competition as well, strong competition in that. So it's not going to be like an Amazon situation, I don't think anyway, where they eat up almost the entire market. But we've gone with 45% market share, which gets them to around 65 or 64 billion it has here in revenue by 2025, which I think is still very bullish. On the profit side of things, well, we're saying that they can get to maybe 10% in 2025, although actually this would probably be a push considering the gross margins don't even hit 20% at the moment. However, they could improve with scale. I'm just being optimistic here, as I say, trying to screen the stock. Free cash flow actually was a little bit better than earnings in terms of what they put out in the prospectus. So we'll say that free cash flow can level out similar to operating income, so around 10% by the end of the period. Shares outstanding I've got growing at 1.5%, just because, like I said, they're going to need to raise some more cash to fuel that growth, I think, over the next 5 years. And with the market cap that they've now got, it won't be hard to, you know, raise a couple of billion every now and again. So I've gone with 1.5% dilution. I'll also say this is a 5-year valuation. I haven't stretched it out to 10 years. I know that that might actually improve the valuation slightly, but I don't have much visibility on how well the South Korean market will do over 10 years. I really don't know that at the moment. And actually, going off of the estimates that, you know, a lot of the professionals have given, doesn't seem like they're agreeing on where the market will be in 10 years either. So I've gone with 5 just to be on the safe side. On my terminal value multiples, I've gone similar to what Amazon was valued at for a long time, which is around 3 times sales. It's currently higher than that, but it was trading at 3 times sales for a long time. So let's say something similar happens here. I've got 3.5 times sales. EV to EBIT, this should say. I've gone with 30 times. Remember that they're going to be growing at 40%, so this would actually be a cheap multiple, yes. But the multiples come down slightly because by the time we reach this point, South Korea e-commerce as a market will begin to slow in its growth, especially when it's got 85 to 90% customer penetration already. And if we look at that in our DCF, it actually shows that we have an undervalued stock, which I was quite surprised with, and that's based off a discount rate of 15%. Ignore that 4x for the moment. Don't know why that's in there. It's actually more like a 2.5x, which is still not bad. It gives us an intrinsic value for Coupang at the moment of $93 billion, or a share price of $54 per share. Margin of safety, unfortunately, we don't have much of a margin of safety, around 10% margin of safety, but looks undervalued based off of this forecast, although we need to remember that this is quite a bullish forecast. If we take this alternative scenario as an option as well, then it starts to look like we could have an overvalued stock. And I'm just saying this because what I've done here with the growth rate is I've gone with 45% and then just tround it down over 5 years. We've got a 5-year growth rate of 35%, which is nothing to turn your nose up at. Earnings don't quite reach the 10% that I put in the previous one. We actually only get to 5%, which in my mind does seem realistic as well, considering, you know, the numbers that they're posting at the moment. I've gone with the same dilution. I've got debt not growing. I've got cash growing at 10%, you know, fueled by all of that growth. The multiples stay exactly the same, 3.5 times sales and then 30 times operating income. And that gives us a value of $58 billion today for Coupang, or $33 or $34 per share, meaning that it's actually about 30% overvalued today. So we have quite a parallel there in both of those different scenarios. So you can see how easily it will swing based off of how quickly they can become profitable, if they actually can, within that period, how fast they're going to continue growing, and really what sort of premium the market is going to put on the company over time. If you want access to the spreadsheet here to change your assumptions and come up with your estimated value for Coupang, you can do so by joining the Patreon page. You will also get access to many more companies that we've covered on this channel already, as well as various other benefits such as my buys and sells, portfolio reviews, votes on companies to cover in future videos, and also the new private Discord, which is going to be used for discussing potential investments, hot stock market topics, and ideas for the channel going forward. If you join today, you still basically get a month free trial where you won't get charged until April. So you can see if you get value out of it, and it's cancelled anytime as well. And that's about it for this video, guys. Just wanted to jump on and give you an analysis of Coupang. There's obviously a lot of noise going around about it. Hopefully I've screened it pretty well for you. And if you are interested, especially in this first scenario, and think that could pan out or something better, then by all means, go ahead and dig in to the stock a little bit more, dig into the company a bit more, and see how likely these assumptions are. If not, then there's plenty of other companies out there that we can pick up, and I'll be posting some other videos about them in the near future. So if you haven't subscribed already, subscribe to the channel and leave a like if you enjoyed the video. Really helps the video, really helps the channel out. And good luck with all your investments. I'll see you in the next video.